Today, we're going to break down a really powerful way to analyze pretty much any company out there. And we're going to do it by looking at two totally different stocks. One is a retail giant you've probably heard of. The other is a super high-stakes pharma company you probably haven't. But by the end of this, you'll have a simple, solid toolkit to analyze investments like a pro.
So let me ask you this. If you had to choose, would you go for the proven retail giant, the stable, dominant player with an amazing track record, or would you take a flyer on a high-risk pharma company, one that was basically rescued from the brink but might just have a game-changing drug up its sleeve? See, this isn't just about picking a stock, it's about choosing what kind of story you want to invest in.
Okay, let's get into it. In one corner, we have what we're calling the juggernaut, a company that is just built on a long history of winning. And in the other corner, we have the turnaround bet, a company that's built almost entirely on the hope for what's to come. These two really represent two completely different paths you can take as an investor.
So first up is our juggernaut, Trent Limited. This is the retail arm of India's gigantic Tata Group. I mean, think of these guys as an impenetrable fortress. They're the established champion, a proven winner with powerful brands and a massive footprint all over the country.
And in the other corner, our underdog, our big swing for the fences, Orchid Pharma. Now this is a company that was basically cracked, almost shattered, before it got acquired and restructured. And now, it's betting its entire future on a couple of huge, but let's be honest, very uncertain scientific breakthroughs.
All right, so let's start by digging into the juggernaut. What exactly is it that makes a company like Trent so dominant? Let's take a look under the hood.
Okay, so Trent's power really comes from having a bunch of different weapons in its arsenal. You've got Westside, which is their profit anchor. It's a lifestyle brand where almost everything is private label. That just means they own the brands themselves, which gives them fantastic profit margins. Then there's Zudio, this absolute hyper-growth machine just pumping out value fashion at an incredible pace. They're even going after the Gen Z market with new brands like Burnt Toast. Now, Star Bazaar is their grocery business, but that one's facing a much tougher fight.
And this quote, man, it just perfectly sums up the challenge they're facing right now. Trent is opening new stores like crazy, but they're running smack into an economy where people in the cities are starting to watch their wallets a little more closely. So all that aggressive growth is hitting a bit of a headwind.
So what does the market think of all this? Well, it values Trent at a price-to-earnings ratio, or PE, of over 90. Just so you know, that is a huge number. Investors are basically screaming, yep, we know you're expensive, but we are more than willing to pay that high price for your proven track record, for your quality, and for that reliable growth.
Now, let's completely switch gears and look at our turnaround bet. You'll see how this builds a totally different kind of story. With Orchid Pharma, we're not really looking at what it's done in the past. We're looking almost entirely at its future potential.
The whole bet on Orchid really comes down to two big things. First, this new antibiotic they invented called N-metazobeltam. And get this, it's already got US FDA approval. That's the green light from the US Food and Drug Administration, which is a massive, massive milestone for any pharma company, especially a mid-sized one from India. Second, they're building a huge new government-backed factory to make a key ingredient that's currently imported from China. And the good news? Since they restructured, the company has very little debt, so they actually have the money to fund these big, ambitious projects.
This quote right here perfectly captures the whole dilemma. The stock price is acting like everything is guaranteed to go right with these future projects. But the company's actual business right now, it's shrinking. There's this huge gap between the dream of tomorrow and the reality of today.
And here is that reality in cold, hard numbers. In the last quarter, Orchid Pharma didn't make a single rupee of profit. In fact, it posted a net loss of almost 6 crore rupees. I mean, it is a complete and total contrast to the super optimistic story that's baked into its stock price.
Okay, so we've got two very different companies telling two very different stories. How in the world do we make sense of them? Well, we can use a simple but really powerful three-question framework that analysts use all the time to just cut through the noise.
It all boils down to these three things. Number one, what's the core story? What does this business actually do, and what makes it special? Number two, what are the numbers actually saying? What's the real financial health of the company right now? And number three, what's the price tag? How much is the market charging you for that story and for those numbers? Is it cheap or is it expensive?
All right, now for the fun part. Let's take that framework and apply it directly to our two companies. Let's put them head-to-head and see what we find out.
First up, the story. Trent's story is one of proven dominance. It's already written in the history books, and you can see it in today's results. Orchid's story? It's a story of pure, unadulterated future hope. It's a bet on what could happen, not on what's already here. Okay, second, the numbers. And wow, the contrast here couldn't be more extreme. Trent is a profit machine. Its revenue grew by 16%, and it made 373 crores in net profit. Orchid, on the other hand, went from making a profit last year to posting a loss, and its revenue actually fell by 13%. One is growing, the other is shrinking. It's that simple.
Now this is the crucial point. When we look at the price tag, both stocks look really expensive with these high PE ratios. But here's the thing, investors are paying for two completely different things. With Trent, you're paying a premium for quality. With Orchid, you're paying a premium for hope.
And just to put Orchid's price tag into perspective, check this out. Other profitable, stable pharma companies trade at PE ratios of, say, 25 to 30. Orchid is trading at over 80 while it's losing money. That's just how much hope is being priced into that stock right now.
So, after all that, which one is the better investment? Well, the real answer is, it depends. The choice isn't really about which stock is better. It's about you. It's about what kind of investor you are.
So, are you a juggernaut investor? Are you someone who prefers the reliability and safety of a proven winner like Trent, even if it means paying a higher price for that quality and lower risk? Or are you a turnaround investor? Are you someone who's willing to take a big, calculated risk on a story like Orchid's, hoping for that massive payoff, but also accepting that you could lose a significant amount of your money?
Because at the end of the day, investing isn't about finding some magical best stock that works for everyone. It's about understanding the story, looking at the numbers, checking the price tag, and then finding the company whose story fits your personal goals and your comfort level with risk. So the real question I'll leave you with is, what's your story?